The Federal Reserve went ahead with an expected quarter-point rate hike despite regional bank weakness and recession fears. Is the economy moving toward a soft landing, or does the Fed have more work to do? And what happens if lower-paid workers start to gain the ground they've lost in recent decades? Joining me now is PGIM Fixed Income Co-CIO Greg Peters. Greg, thanks so much for coming in the studio. Appreciate it.
Thanks for having me.
So let's start with Friday's jobs number, stronger than expected. And one interesting data point was that the share of prime-aged workers in the workforce didn't just go back to pre-COVID levels. It's actually higher than it's been since before the great financial crisis. What does that say about the economy?
It says it's strong, plain and simple. So that coupled with the fact that wages also accelerated, a 0.5%, the labor market looks extremely strong. This is the 14th straight labor report that beat expectations. We have an unemployment rate that dipped to 3.4%. The labor market is as strong as we've seen it in a very, very long time.
So let's find the cloud around that silver lining, which is, of course, this is inflationary. The Fed's trying to tamp down inflation, and all of this is good for growth, but good for inflation, which is not good.
That's the tricky part, right? So if you look at the services sector, it's 56% of the inflation basket. That is driven by wages. So it's really difficult, almost impossible, to shake inflation out of the system when the labor market is strong as it is.
Especially when the Fed's instrument is pretty blunt, right? Just raising rates doesn't necessarily mean that the hotel is going to pay lower wages or hire fewer people. Do we get any help, as perverse as it sounds, from this banking turmoil where especially regional banks are going to be pulling in their horns, lending less money?
Well, I think that remains to be seen. I do think that will happen. The question on the table, however, is how that will be pulled forward and how acute it will be. So it will have an effect because the regional banking system is really into the smaller communities, the medium-sized businesses, so they're most affected. But the starting point is really quite robust.
Okay, well, let's hope maybe it helps the Fed a little bit. I want to go back to wage growth because that's interesting. A McKinsey study says that since the 1980s, labor's share of GDP has been shrinking a little bit. That's helped company margins, et cetera. Do you see a structural change here as wages go up? Is it possible that essentially labor is going to have a bigger piece of the pie?
I do. If you look at the past couple decades, it's been punctuated by the return to shareholders. I think that is changing. I think it's a secular shift. And so with labor becoming more forceful, with wages coming up, I think that changes the dynamic of the economy. I think it changes the dynamic of the Federal Reserve response function. And quite frankly, I think it's more balanced and more equal.
There's obviously good news for those workers. For shareholders, though, less return? I mean, does that mean the next decade may not be as generous in the stock market?
I think so. We're coming off of record margins. So margins have been really elevated for quite some time. And so that will eat into the margin picture and pressure. But on balance, that discretionary income going into that part of the society and that part of the population, I think, more than offsets it.
Okay, so what is the investor playbook if those changes come to play?
Well, I think it's too early right now, but
okay.
I do think it actually bodes quite favorably for bonds. So I don't foresee the same type of returns on the equity side that we've kind of experienced in the past. I think it's a more balanced portfolio. I think fixed income and income part of fixed income really starts to assert itself. So I foresee investors moving into this more balanced portfolio scheme where there'll be less equity exposure, more fixed income exposure, given the fact that margins and returns will be lower, but also income higher on the fixed income side.
Said like a true fixed income manager. So, Greg, with this fight over the debt ceiling, do investors have to worry about whether the government will actually pay them back if they own short-term bonds?
There is a real risk on the table. So we've assigned a 5% probability, and the fact that we've assigned any probability is notable in and of itself. So it's all about the X date, which is when the government runs out of cash, runs out of money. And so we think it's mid to late July. Some others think it kind of in June. But either way, it's this chicken and egg type of reaction function where it has to get sufficiently worse from a market perspective to get policymakers to do something about it.
Sure.
So it's a very dangerous game to play. So there will be more volatility in the market. And as you mentioned, the short end, The T-bill part, which is supposed to be safe,
Right.
there's lots of kind of dislocations given where that X date is landing.
Let's hope for some compromise and a solution.
Absolutely.
Greg Peters, thanks so much for coming on the show.
Thank you.